Why did gold and silver prices dive? We got naval ships that are going to bring oil tankers through the Straits of Hormuz. Whoop! Down goes oil prices, down goes gold prices. Right in front of everybody's eyes, total lie. An illegal trading in the futures and precious metals market. Gold did not decline because the dollar is going up and because of spiking energy prices. Inflation will rise, the Federal Reserve won't lower interest rates. We see it as a rigged game. And we're not saying it's another JP Morgan Chase rigged game. They're doing everything they can to keep gold prices down because it's showing the dire strait of the United States economy. After February 28th, it was down $600 million a day. How about $1 billion now? How about the energy prices in Europe?
This is not a free market in gold that there's a real breakout would expose that deeper weakness. Who exactly is the they in your view right now? Is it central banks? Is it the bullion banks? Is it governments? Is it large funds? You know, what do you think?
It's a damn crime syndicate. People call it government. You got this guy, Trends Journal, that on the gold side, as a result of the U.S.-Israel tax on Iran, remember, we wrote this on March 3rd. Over the weekend, gold had spiked to the $5,400 an ounce range on Monday. But then, in a blink of an eye, when the equity markets opened in the U.S., prices fell over $200 an ounce. Why did gold and silver prices dive? And we go on to say, once upon a time, not too long ago, JP Morgan Chase was fined for rigging the precious metals markets. Here is what Reuters, so you know it's mainstream, reported on September 29th, 2020. JP Morgan Chase & Company has agreed to pay more than $920 million and admitted wrongdoing to settle federal U.S. market manipulation probes. It goes on to say that the regulatory shadow that hung over the bank for several years and marks a signature victory for the government's efforts to clamp down on illegal trading in the futures and precious metals market. So we go on to say, as we see it, gold did not decline because the dollar is going up and because of spiking energy prices. And yes, inflation will rise, and again, we said this, the Federal Reserve won't lower interest rates.
A $200 drop in gold within hours isn't volatility. It's a signal something deeper is controlling price action. As Gerald Celente points out here, the timing of that sell-off right at US market open raises questions about liquidity flows and institutional positioning. A $920 million fine back in September 2020 didn't eliminate manipulation. It exposed how entrenched it was. Meanwhile, if inflation is rising and the Fed holds rates steady into upcoming meetings, gold logically shouldn't collapse like this. That disconnect matters for portfolio hedging. Next, Gerald Celente unravels why this may not be a free market at all.
We see it as a rigged game. And we're not saying it's another JP Morgan Chase rigged game. What we're saying is that they're doing everything they can to keep gold prices down because it's showing the dire strait of the United States economy. And we go on to say that you got Trump coming out right after it happened. Hey, the war's almost complete. It's almost complete. Oh, you forgot that one, everybody? Oh, it's almost complete? That was on March 3rd. How about this guy, Chris Wright? How about calling him Chris Wrong? The little clown boy playing the Secretary of Energy. Remember he came out and BS'd? We got naval ships that are going to bring oil tankers through the Straits of Hormuz. Whoop! Down goes oil prices, down goes gold prices. Yeah. Right in front of everybody's eyes, total lie, one after another. We believe they're doing everything they can to keep these prices down because these prices should be skyrocketing. They should be off the charts. Again, I've been at this for 46 years. Never in my life has I've seen anything like this going on.
When headlines shift overnight, markets don't just react, they get steered. As Gerald Celente points out here, the sequence of optimistic war messaging followed by immediate drops in oil and gold prices suggests narrative-driven pricing, not pure fundamentals. Markets price future expectations, but when those expectations are based on statements that later prove unreliable, investors are left holding mispriced risk. This is especially critical with energy-sensitive sectors and inflation hedges. If geopolitical risk is understated, portfolios could be dangerously exposed. Next, Gerald Celente discusses who may actually be behind this pressure on prices.
Again, read one article after another around the world. Oh, over in the Middle East, what did they say? Tourism. Oh, that was when the thing started after February 28th. Was down $600 million a day. How about $1 billion now? How about the energy prices in Europe? How about, hey, listen to me. I'm the president. Here's my State of the Union address, all right? Hey, in most states, the price of a gallon of gas is $2.30. Of course, it wasn't. It was $2.92. But anyway, that was the State of the Union address a couple of weeks ago. What is it now? Google it up. Well, on Friday, it was $3.91 a gallon. This is going to destroy the economy. The people are broke already.
I want to dive into this with you, Gerald, because, I mean, a lot of our audience will be paying attention to what you say. They've felt the same way, this Main Street versus Wall Street. I mean,
the numbers being reported and the reality people feel at the pump are clearly diverging. As Gerald Celente points out here, when gas prices jump from around $2.92 to nearly $3.91 in just weeks, that's not stable inflation. It's accelerating cost pressure, hitting consumers directly. Tourism losses nearing $1 billion a day and rising European energy costs signal global demand stress, not recovery. Yet official messaging often lags or softens this reality, which distorts investor expectations. For portfolios, this means watching consumer discretionary and transport sectors closely. Next, Gerald Celente shows why this disconnect is widening.
You're saying that this is not a free market in gold, that there are interests who want to keep gold prices contained because a real breakout would expose that deeper weakness in the system. Who exactly is the they in your view right now? Is it central banks? Is it the bullion banks? Is it governments? Is it large funds? What do you think?
It's a damn crime syndicate that people call a government. You got this guy, Bessent, coming out. Again, we had this in the Trends Journal too. He went on to say that, are they rigging the oil prices? He said, we don't have any, quote, plans to do that. Plans? Or you don't have a plan to do it? How about say we would never do something like that?
Yeah.
Again, the game is rigged as far as we can see. This prices should be spiking off the unbelievable. They should be, again, you got inflation. It's not about the dollar, it's about inflation. And again, prices should be spiking.
If gold is a true signal, then suppressing it keeps bigger economic problems hidden. As Gerald Celente points out here, when officials avoid outright denial and instead say they have no plans, it leaves room for interpretation, and that ambiguity matters in markets. Inflation-driven environments historically push gold higher, yet current price behavior suggests external pressure or heavy positioning. Investors relying purely on dollar strength narratives may be missing structural risks beneath the surface. This isn't just about metals, it's about trust in price discovery itself. Next, Gerald Celente unravels how deep this influence might go.
And again, you go back here. You ready? This is from the Wall Street Journal. Let's see, March 12th. Ready? U.S. trade deficit shrinks 25%. You know why? Driven by gold exports. Bop.
Yeah.
Driven by gold exports. Never heard anything like that before in my life. That's the demand for gold. Again, they're doing everything they can. Again, it's one BS after another. The war's over. This is over. That's over. This is them. The ship is going through. We're not. Again, the facts are all there for anybody to look at. And, again, we're political atheists. We look at things the way they are, not the way they should be. Again, Steve Eisman says investors should ignore U.S.-Iran war will be long-term positive. This is when, going back to, again, March 3rd. They're saying, no, don't worry about the markets going down. What are you talking about? Oh, wait. Let's go back to, again, what Trump said. Hey, the markets are over, the Dow is over 50,000. By the time I get out of office, it's going to be over 100,000. Oh, what's it now? It's in the 45,000 range. The Dow's up. Like the way the markets are going down around the world. Look what's going on in Asia. Look what's going on in Europe. And again, this was going down before this happened. That's the most important thing. The equity markets, again, one of our top trends for this year is .com bust 2.0. And you're seeing it already. You're seeing the money pulling out of private equity funds, and they don't have the money to give back to the people that want it. Oh, you only can get 5% back. I want it. You can't get it back. This is going on before the war began. Prices of gold should be skyrocketing along with silver.
Yeah. So, I mean, your point is that the gold tells the truth about the dollar and America's imbalances, and that this is exactly why, in your view, officials do not want that signal running freely.
A shrinking trade deficit sounds bullish, until you realize it's being driven by gold leaving the country. As Gerald Celente points out here, a 25% drop tied to gold exports isn't economic strength. It's a signal of underlying demand stress and capital movement. Meanwhile, equity markets were already weakening before geopolitical headlines, suggesting liquidity was drying up beneath the surface. Private equity redemption limits and global market declines point to tightening financial conditions investors can't ignore. This isn't a clean cycle. It's a fragile unwind. Next, Gerald Celente unravels why this correction may already be locked in.
I mean, do you see this correction happening? What are your thoughts?
It's going to happen. It has to happen.
Let me ask you a follow-up on that, because you brought up that $200 billion. And I mean, the Pentagon has reportedly, that's the number they asked Congress for, another $200 billion tied to this campaign. Meanwhile, EIA data shows, diesel prices in the U.S. have pushed past $5 a gallon, which matters because, I mean, diesel runs everything, agriculture, large parts of the industrial economy. When the cost of war lands so directly on the kitchen table, does the public's view of the economy finally start to break?
The public's view of the economy is already down.
Yeah.
And again, I told you 92% of the people supported Bush's war. I mean, depending on who the numbers you're looking at, it's about 57% of the people are opposed to this war. The people are going broke. They call it a K-shaped economy. A K at the top is the other people down by. Throw an FAU in a C in that K-shaped economy. Here, look at the numbers. Not too long ago, the average age of first-time home buyers in America was 28 years old. You know what it is today? 40. 10% of Americans are responsible for 50% of all the spending in America.
Rising diesel prices above $5 aren't just inflation. They're a direct tax on the entire economy. As Gerald Celente points out here, when war spending climbs toward another $200 billion while consumer sentiment is already weakening, the pressure shifts straight onto households and small businesses. A K-shaped economy, where 10% drives 50% of spending, is inherently unstable, especially as home ownership ages jump from 28 to 40. That signals shrinking middle-class participation in growth. Investors should watch consumer sectors closely for cracks. Next, Gerald Celente discusses how war dynamics could trigger broader market fallout.
We said if the United States and Israel goes to war against Iran, you're going to see oil prices spike to above $100 a barrel into the $130 a barrel range. And that's going to crash the global equity markets and the global economy. They're not going to be able to take over Iran, we said. This is a country of 1 million people. They're very advanced. These are the Persians. They've been preparing for this for a long time. They're very advanced scientifically, technologically, and militarily. You're not going to wipe them out. So yet they could talk all they want about taking over the Straits of Hormuz. Again, let's go back to how they were saying, hey, it's not a problem. It's not a problem. Remember? Remember when they asked, didn't you prepare for this ahead of time? Well, we had plans. Some crap that they're spewing out. They're not going to be able to take it over. This is very serious. Yep. This is what Trump said on March 14th. Trump says, quote, many countries will send warships to Hormuz amid Iran blockade. And the Bronx used to say BS has its own sound. It ain't happening.
Markets are pricing stability while the underlying risk points to a potential oil shock. As Gerald Celente points out here, a move toward $100 to $130 oil would ripple through equities, compress margins, and likely trigger a broad risk-off environment globally. Yet current positioning suggests investors are underestimating both the duration and scale of conflict risk. Supply chain exposure, especially in energy-intensive sectors, becomes critical in this scenario. If oil spikes, inflation expectations could reset higher, just as growth slows. Next, Gerald Celente shows why expectations around control of key trade routes may be misplaced.
Trump, March 4th. Their leadership is rapidly going. Everyone that wants to be a leader ends up dead, he told reporters at the White House. You ready? Their missiles are being wiped out rapidly. Their launches are being wiped out. No, they're not. No, but this is March 4th. All right? It's one after another. They're not going to be able to take this. It's going to make a very bad situation worse. Trump says everything's been knocked out in Iran. All right? President Donald Trump Tuesday, they knocked out most of Iran's military. Yep. This is when, a couple of weeks ago, when that clown Merz was there, the Chancellor of Germany. They have no Navy, it's been knocked out. They have no Air Force, it's been knocked out. They have no air detection, it's been knocked out. Their radar hasn't been knocked out. Oh, that's the other thing that's so important. Here, wait a minute. Here's one more about more BS. Iran war. This is CNBC, March 12th.
When official narratives claim total control, but reality contradicts it, markets are left pricing fiction. As Gerald Celente points out here, repeated claims of neutralized military capability clash with ongoing risks, which should logically keep volatility elevated across energy and defense sectors. Investors relying on these narratives risk underestimating tail events that can reprice markets overnight. This is where sentiment diverges from fundamentals, creating sharp corrections when reality catches up. The timing of statements around early March also aligns with market swings. Next, Gerald Celente unravels how these narratives influence price suppression.
U.S. Navy will escort oil tankers through Straits of Hormuz, said Bessent, the Treasury Secretary. That was always in our planning, that there's no chance that the U.S. Navy or perhaps an international coalition, but my belief that as soon as it's military possible, the U.S. Navy and perhaps with an international coalition will be escorting vessels through the straits. This is why they bring down prices. They lie about this stuff right in front of your eyes. So going back to the war's not ending, they're not going to be able to take over Iran. They're not going to be able to take over the Straits. Hey, remember when they bragged about sending all of the aircraft carriers and ships before all this happened into the Middle East? Oh, hey, where's the Abraham? Where's the Gerald Ford? Oh, where are these aircraft carriers? How come they're not over there? Oh, you said there was. I'm telling you. Hey, here again. I launched Occupy Peace, by the way, over a decade ago. I had major peace rallies. Roger Waters just did a live broadcast when I did with Judge Napolitano, Scott Ritter, Dennis Kucinich, on and on and on. So I'm a man for peace. So it ain't BS. Let's go back to what war has America won since World War II? Let me know.
Promises of secure shipping routes can calm markets temporarily, but execution is what actually matters. As Gerald Celente points out here, when military assurances don't visibly align with deployment reality, confidence becomes fragile, and pricing can shift quickly. Energy markets in particular depend on uninterrupted flow through key choke points, and any disruption risk should keep volatility elevated. Investors ignoring these gaps may be underpricing geopolitical risk premiums across commodities and global equities. This is where narrative diverges from logistics.